Hey, so welcome to the webinar. It's not about the numbers, it's about your game plan. So the context is, how does investors look at your ideas when they look at your pitch and the financials that comes with it? So we're going to kind of unpack that today. So a bit of introduction about myself and Yvette. So I'm Dr. Yong Shin Ning. I spent 20 years in corporate in Arthur Andersen and Accenture, managing huge IT projects in change management. And I have now transited into becoming an academic educator as well as an entrepreneur. And my area of focus is on business innovation, whether in startups or matured SMEs. And together with Yvette, we also invest in a few startups. And Yvette, she spent 20 plus years in oil and gas in Shell, and her focus area is in analyzing complex commercial deals, which are in the amount ranging between millions to billions. And of course, she is also an angel investor together with myself. Okay, so that's in a nutshell, the two of us, and we will be bringing you this webinar this morning. A little bit about the company that both of us run. It's called the Biz Lab. And what we do is we help incubators and accelerators to increase the chances of startup success through using data-driven insights and digital tools. So today, this is part of our outreach program for the startups that is within our incubators and accelerators partners. So what will you learn today? So you will learn two things. Firstly, you will learn what investors really value in a startup. And with this knowledge, it will help you better align your pitch and your business plan with their expectations. But there is really many ways to skin the cat. So the angle that we're going to talk about this topic is by looking at the relationship between investability and numbers, really your strategic cash flow projection. I know everyone is on mute, but I may have here groanings because numbers is not a natural first language for many of us. So when we talk about numbers, a lot of people will feel scared. They will feel that it's very daunting, and some of them maybe even give up trying to figure out what kind of numbers do they need to present to investors. So today, by the end of the session, we will make it very simple for you, and hopefully you will be able to tell a strategic story with your numbers when talking to investors. So the first topic that we want to talk about is, what do investors look for? And then we will talk about, is then your idea investable? So what investors look for and whether your idea is investable seems like two sides of the same coin, but really one is from the investor's perspective and one is from the startup or your perspective. Okay. And then we will do a little bit of practice, getting you to stand in the shoes of the investors and practice the key concepts that we talked about in this session. To talk about what the investors are looking for, I want to first bring you through the investor experience when they first listen to the pitches of the startups. Okay, take a look at this optical illusion and tell me what you see. If you could type in the text chat, do you see a beauty or do you see a witch? Do you see a beauty or do you see a witch? Can you type in the text chat? Okay, So we have some people who see wit and some people see beauty. So this is the same kind of confusion that investors are also faced with when they listen to startup pitches. And let me explain why. So typically on demo day, startups would like to hear, hey, you've got a deal. And unfortunately, that's not the end of the pitch, because once the investors get interested in the idea, they will most likely say, hey, that's an interesting idea. Now step me through the numbers. Very often, some startups would be able to tell a strategic story with their numbers, but more often than not, based on our experience sitting in demo days, sitting on panels, judging startup pitch days, we find that investors are very often confused by the numbers that the startups present. And let me explain why this is so. Typically, in the pitch decks, you will only see revenue projections. Okay, so you can see from this simple screenshot that I'm presenting that this company is going to go through exponential projected growth over the 5-year period. So can you tell whether this startup is a witch or a beauty? And if you can't tell, what information, what else would you need in order for you to judge whether is it a witch or a beauty? If you can type into the text chat, what other information do you need? What other financial information do you need? Yeah, profitability, exactly. Exactly. So the cost aspect is, where are you putting in your money to drive the growth? When are you going to, put in your marketing dollars? What is your marketing strategy? How would you acquire customer? How would you retain them? When would you be, expanding overseas to get to your growth targets? How much would you be spending in IT, for example? How scalable is your business? So all these are the how and the when. So I see in text chat, the monthly burn. So that's the when. When are you spending the money? So the how and the when is not reflected in this picture. So it is actually impossible to tell whether is this a witch or a beauty. So based on all your responses just now, we now can conclude that when we want to present an idea to our investors, we need to present it holistically. Okay. Our pitch deck story typically tells the why and what, which is kind of that, very beautiful exponential trajectory that we saw in that screenshot. But it needs to be complemented by the strategic cash flow story, which is the how and the when. So the cost part, where are you putting your money? When are you putting your money? How fast is your money being consumed? And where is it being consumed? And only with that right-hand side story can you tell whether is it a beauty? Is it profitable with the uptick in the cash flow hockey stick? Or is it going to be a witch, which is bleeding cash all the way? So numbers, your strategic cash flow is not an afterthought. Okay? It's not something that you don't know what else to do with it and you just quickly shove a slide showing upward trajectory to show the investors. The what and why and the how and when needs to be integrated. But this is still very complex for a lot of startups. What do you mean how and when, and how does it integrate with the why and what? So fret not, we have a very simple framework for you to follow. So this is our 4-step framework, and we have published this framework in the Asian Management Insights last year. And in the follow-up email to you, we will send you the link to this article as well. So what investors look for can be distilled into 4 major elements. So the first element is to show investors actually what is your current traction so that you build trust with the investors. Because a lot of the numbers are around projections, so it's your future earning capability from your business. But to convince the investors that you have the ability to deliver on the promise, you got to show them some of what you have already delivered, which is your current traction, and is to build trust. Then the next step is to show your vision. So how do you propel your company to achieve the growth targets that you promise? What is your marketing customer acquisition strategy? What is your retention strategy? What is your expansion strategy? What is your strategy to continue keeping that defensive moat around your business? So articulating the vision. But not everything or nothing will ever go according to your plans. And therefore, in your presentation to the investors, you also need to articulate that you have considered the risk that will come together with your base plan, and what are then your risk mitigation measures. And finally, investors will look at what is that reward at the end of the journey for them. And the traction, growth, and risk are then rolled into the reward that they are expecting to get. Okay, so when you show investors your ideas, they will typically look for current traction, growth, risk, and reward. But how do all these go into a cash flow projection? You may be wondering, how do I put all these concepts into a cash flow shape? So we have dissected that for you and shown it to you in a typical cash flow hockey stick. So the first part of the hockey stick where there is a slight dip there is typically where you are trying to establish product market fit. Okay, so there is a slight dip because you are making some investments there. So this is the demonstration of the current traction. And once you have gotten a bit of traction, then you are in the position to seek early investor funding because you have something to show for. Then you go into your second stage, which is your growth, and you can see the cash sink is deeper now because you will invest more resources to achieve that growth that you desire. But as I said just now, things are not always going to go the way that you expect. It could go up, but it could also go down. So looking at the potential risk involved and then embedding the risk mitigating measures is then what will be reflected in your cash flow hockey stick. Okay, finally, that last part of where the cash flow trajectory ends up is the reward. Is it up or is it down? Okay. So you can see that the TGRR, traction, growth, risk, and reward, is embedded within your strategic cash flow projection. It is not something separate. It is not something that is an afterthought. So in summary, your game plan is reflected in your cash flow projection. But similarly, the lack of a game plan is also easily seen in your strategic cash flow projection that you show to investors. So do remember that the cash flow projection tells the story of how you want to achieve your goals. So we have looked at what investors are looking for. Now let's turn the lens and look at whether is your idea investable. Okay. So we think that, isn't that the same thing? Investors have a set of criteria that they're looking for, but for you, your business idea is your utopia. It's how you live out your dreams and your aspiration. So there are some things that you need to consider, whether is it a fit for yourself as a startup, as an entrepreneur. So let's look at whether your idea is investable from your angle, and then we will see how it matches with what the investor wants. To get an idea of what are the things to consider in ascertaining whether your idea is investable, there are 3 things to consider. The first thing is the potential of your idea. Is it an idea that is in the red ocean? A lot of people are already pursuing it and the market is extremely crowded and competitive? Or is it an extremely transformative and disruptive idea that no one in the market is pursuing at all? After you have established that potential of the idea, then you need to think about, how do you desire for this business to grow? Are you thinking of hyper growth and then exiting at the earliest possible? Or are you thinking of having a business that is sustainably profitable and will earn you a comfortable living, like a lifestyle business? So that's your purpose. And the third thing is, do you know the pathway, the how and when to achieve your potential business model and your desired growth trajectory? So these are the 3 Ps that any startup founder or any business owner going into a new line of business would need to think about. So we have made it easy for you to find out, to gain clarity of your 3 Ps. And we have done so using a very simple diagnostic quiz called the Startup Zodiac. So for those of you who have already gone through Startup Zodiac, which actually is all of you, let me just quickly recap the significance behind the 7 animals in the Startup Zodiac. So there are 3 animals, the gazelle, the camel, and the penguin, that stands for disruptive ideas. Then we have the horse and the pony, that stands for incremental innovation. And finally, the business that cannot make it or is doomed for failure is the donkey and the cockroach. So later on, in a separate exercise, a few slides down, I will go into details about what's the differences between each of these animals. After people have done the Startup Zodiac and gained clarity about what is their 3 Ps, we got a lot of feedback to say, hey, I thought the Startup Zodiac sign for each founder should be only 1 sign. But actually, that's not the case, because we are looking for alignment between the various Zodiac signs. For example, in the example that you see here in the screenshot, if you have alignment between your business model potential, which is a horse, which is a great business model, although it's not disruptive, it's only incrementally transformative. It's aligned with the desired growth trajectory, and you have good awareness of the cash flow trajectory, then this is good. It means that it is aligned for you. However, if you have a business model that has not as great a potential, maybe a pony business model, but you desire a very, very steep and very high growth, very fast paced and high growth, like a gazelle, then there is a misalignment between the nature and the potential of your business model and where you expect to bring it to. Okay, so that misalignment needs to be addressed. And thirdly, if you have no idea of your cash flow projection or cash flow trajectory, you're not sure how to navigate uh, and chart out an implementation path for bringing your growth as well as your business, then you will most likely end up with a cockroach or a donkey. Okay? So this is a brief summary of how you would interpret the Startup Zodiac report, which all of you have. But remember just now I mentioned that the what and why and the how and when are always integrated. The how and when is manifesting in the cash flow shape. So likewise, there is a cash flow shape behind each of these zodiac signs. So let's go through a very simple and quick exercise and a fun exercise to understand what is the cash flow shape behind each of these zodiac signs. Okay, I'm not going to tell you the answer, and let's have a kind of like a discussion here. So this is three cash flow projections of three of the zodiac signs, which are representing disruptive ideas. So these are the zodiac signs or the businesses that are in the blue ocean, okay, the gazelle, the camel, and penguin. Can you type in the text chat? What animal do you think match to A, B, and C? So what animal matches to A, B, and C, the cash flow shape A, B, and C? So I'll take a pause and I'll see whether you have gotten that right. So A has a typical cash flow trajectory, a little bit of dip, a deeper dip, and it's going steeply up. The orange curve, the dotted one, spends a little bit more time in the before it's profitable. So there is more upfront investment that is undertaken in the cash flow hockey stick that is in orange. And in the pink color one, we're not very sure whether it's ever going to be profitable. So any thoughts? A, B, and C match the zodiac sign. Okay, excellent. We have some responses coming in and exactly right. So A is gazelle, and gazelle is typically represented by fast tech kind of businesses, and it is extremely, extremely scalable, and it doesn't require a significant amount of gestation period before it can go to market and it can be, revenue generating. So examples of such businesses are Facebook, Google, Zoom. Camels are those more deep tech kind of businesses that, as I mentioned, require more upfront development investment and a longer development time before it can go to market, and even longer before they can be profitable. For Penguin, these are the businesses that target to increase their exit value, maybe by having as many customers as possible, and investment is required to grow their revenue and users. And these businesses, many a times, do not focus on demonstrating that they are having a profitable and sustainable business model. So another term that we typically use for such business model is grow at all costs kind of business model. Does anyone know or is curious as to why it's called the penguin sign. So gazelle, you can understand, right? Because it's the fastest, it's a very fast animal. Camel, it's a very slow animal, and it has, it needs to have a lot of reserves. What about penguin? Any guess? Why did we choose this this animal? Penguins burn so much energy. Actually, that's true. They survive in large hordes. Okay, reason the reason why we chose penguin is because we read that emperor penguin specifically, after the mother births the baby penguin, the mother will leave the baby penguin under the care of the father. And then the mother penguin will leave the family and go away and do something. I'm not sure what. So that's why we wanted to use this, this interesting trait of the emperor penguin as to signify a business that is just focusing on increasing exit value. Okay, great. So let's try. So this is the answer for disruptive ideas. Okay, does anyone know why unicorn is not in this picture? Why is unicorn not in this picture? This is related to a concept that we talked about just now when we talk about witch and beauty. Can we even draw the cash flow shape of a unicorn? Is it possible to draw a cash flow shape just from the definition of a unicorn, which is more than 1 billion US? Yeah, because it's just the revenue side, the valuation side. What about the cost side? So unicorn, we can't even plot the cash flow because it's only 1 billion is only the valuation. It doesn't talk about the cost. Okay. So as we said just now, we need both the what and why and the how and when, which is the cost, to know whether this business is actually a witch or a beauty. And we can't feature unicorn there, and we don't know whether it's a witch or beauty. Okay, moving on. This one should be easy. So we have another two cash flow shape for existing ideas, not disruptive, maybe incrementally transformative. So one is the horse and one is the pony. Okay, so you see two cash flow shape here. One is there is a small dip and there is then a slightly more investment, but the upward trajectory is not as steep as the gazelle. And then there's another one, the blue dotted line, which is a little bit more gentle and gradual. So what does D represent and what does E represent? Any thoughts? So yeah, so D is for horse and E is for pony. So pony is your lifestyle business, not so much upfront investment, your F&B, retail and coaching business. But you can earn a pretty decent and sustainable profit from this business if you have the right niche and a good way of getting customers and retaining customers. For horse, this business is more global, requires a bit more investment. Although it's not transformative, it's not disruptive. It's not disruptive, it's incrementally transformative, but yet it has a global reach and it can be very big. So Morgan, do note that we have actually put Dan Global there as a shout out to the good work that Dan has done over the past years. Okay, anybody knows what a zebra is? Has anybody heard of this zodiac sign called the zebra? Yes, no? Okay, so zebra typically represents businesses that focuses on both impact and profitability. So what you would typically call social enterprises. So it can typically be a pony or a horse cash shape, and maybe even it can be valued at 1 billion and it can be a unicorn. So a lot of founders come to us and they say, "Oh, I'm a social enterprise, and therefore, I need to be, not earning money, or I need to be subsidizing." But that's not the case. There are many examples of uh, social enterprises that can be either a pony or a horse, and there's good balance of both impact and profitability. Okay, this one should be very easy. Two lines all below the x-axis. So which one is a donkey and which one is a cockroach? Yep. G is a cockroach, which means that F is a donkey. So does the cockroach line do you remember that it is similar to another cash flow shape that we saw earlier? Is the cockroach cash flow shape similar to another animal's cash flow shape that we saw earlier? That's right. Thanks, Rebecca. It's penguin. So as I mentioned, um, sorry, G is actually a donkey because it's G is a donkey because it's bleeding cash. So it's unable to break even, so it's downward all the way. Apologies. So G is a donkey and it's similar in cash flow shape to a penguin. Remember, in the first one, it's also downward. The reason is because sometimes when we start a business and we want to invest heavily in customer acquisition, or just maximizing exit value, we are bleeding cash. And because we have not demonstrated whether that business model is profitable, so it could turn out to be a donkey. So a cockroach is one that is struggling to survive. It can break even operationally. So every month your revenue and your cost kind of offsets, but you never really recover your investment. So you can't grow because you are not profitable. So this is a business model failure. And when we spoke to a lot of startup founders, it is actually very challenging. Cockroach is especially challenging because you're emotionally attached to that business, and it's very difficult to kind of cut it, even though it's merely surviving. Okay, great. So all of you are now familiar with the cash flow shape behind the zodiac signs of these 7 animals. So the question is, what is your own business cash flow shape? Do you know that? Which animal does it more represent? So now we're going to take some time to practice standing in the shoes of the investors and connect what we learned in the first 2 sections. Okay, we have 2 case studies that we want to go through. The first case study, let me just first orientate you since there's a lot of numbers and it can be a bit busy. So we have 2 reports that I'm showing you on the screen. The first report on the left is a cash flow projection report. So it's 5 years. And the right-hand side is a valuation report. So these 2 reports are generated from our quick look cash flow tool, some of whom on the call have used it before. So let me walk through this first set of reports, and you can tell me whether you as an investor, would you be likely to invest in this based on the story that these numbers are telling? Okay, first thing to note, this business is always going to be cash flow positive, or at least that's what the founder is saying. The founder is saying from year 1 until year 5, it's always going to be cash flow positive. And the gross profit margin is going to increase steadily from 16% to 44%. Okay, so seems like a good deal so far. And they are asking for 1 million of angel investment or VC investment, and they are promising 42x. So the cash on cash return, the investor X factor is 42 times. So let me take a pause here. Just mull on those numbers that I shared. Would you, as an investor, at first glance, based on these data points, invest in this startup that is pitching to you? Yeah, 42x seems like a great deal. Yeah, so we have a lot of people. So on the surface, it looks great. Okay, let's get more information. So it seems like, yeah, this seems like it's worth investing. Okay, we have a little bit more information. So we also asked the founder to project his cost of customer acquisition and retention. So his ratio of cost of customer acquisition and retention as a percentage of revenue is declining from 15% to 1%. So for every $100 that he earns, he's only putting in $1 at year 5 to achieve the revenue that he wants. We also did a sensitivity analysis for this business. And if he misses the revenue target by 50%, then you can see just at a glance from the red fonts that his business is not going to be viable. Okay, it's going to be red all the way till year 5. Okay. So will you or will you not invest in this business? Have you had a change of mind? So it's very difficult. So you can imagine if you bombard the investors with too many numbers, they also can get overwhelmed. So it's actually very important for you to take control and have clarity on how you want to tell a strategic story with your numbers. And I bring you back to the framework that we talked about in section 1, which is the TGRR framework. Okay. So structure the way that you present your ideas to the investors in this framework, and it'll be easier. So let me then debrief this case study 1. So we don't know much about the current traction because it was not reflected in the submission. So we don't really know how much this business has already earned. But in the G, we know that the marketing and retention spend is too low to achieve growth targets. So a ballpark kind of ratio would be around 20-30%. 1% is definitely too low. So it seems very difficult to achieve the growth targets that the the startup is looking at. And it's also very unclear where the economies of scale is coming from. So you can see from the earlier slide that the profit margin is going to increase steadily over time. But where is the economies of scale coming from? It is difficult to tell. There was no upfront investment of tech, so it's very unclear. And also, it's unclear why funding is needed. So this business is cash flow positive all the way. There is no cash sink at all. So it's very difficult to explain to the investor why funding is needed and where are you going to use the funds for. Furthermore, on the risk part, it's quite clear that if 50% of sales target is not met, which is actually quite a common risk, then the business plan is not viable. Therefore, in articulating to investors, there needs to be mention of risk mitigating measures. For example, increasing the marketing spend in our sensitivity analysis will actually boost the profitability, and yet it is still going to be sustainable. So it's by increasing your marketing spend, it is not going to, damage the business significantly. It is a risk mitigating measure. And also competition was not considered. So there is promise of high profitability or high profit margin. But if there is high profit margin, then definitely it will attract competition into your business. Has that been considered? Okay. And finally, 42x is really too ambitious and unrealistic. Okay. Just based on all the data points that contribute towards that 42x. Okay, so it seems like 42x is it seems very attractive, but when we kind of unpack it using this TGRR framework and looking at those data points, we need to take a second, we need to think about it again. Okay, a very quick case study too. So in this case study, it is a tech company. So the founder has already bootstrapped 500,000, $500,000, and he's seeking for 2 million of VC angel investment here. And you can see that there is basis for him to ask for 2 million because there is a cash sink in the year one, which is about 2.3 million. So he's not just plucking the numbers out of thin air. There is a basis for him to want to raise a certain amount. And we can also see that he has got upfront heavy investments over time. And we can see that the profit margin increases. Presumably, the economies of scale is from the use of tech. So there is a basis for the economies of scale. So credible so far. And his cash on cash return, though not as attractive as the one just now, is about 25%, which is actually still very, very good. And here we can see that his marketing spend is significantly higher than the case that we saw just now. So even at the 5th year, it's about 35%, which by rule of thumb, it is the approximate ballpark, although the specifics will actually depend on the industry. Okay, so same as the case study just now, when we ran the sensitivity analysis, if he misses the sales target by 50%, then again, this business is not viable. But he can then mitigate using increasing the marketing spend and potentially also the IT spend. So based on all these factors, and you compare what the founders present in case one with what the founder has presented in case two, would you be willing to take a closer look at the startup in case two? Yes or no? So based on the data points that we see from case 2, it is more credible than the one in case 1 because the numbers tell a strategic story that corroborates with the growth story that the startup founder is trying to communicate. Okay, so I hope you have taken away what is a quick and easy way for you to combine your what and why with your how and when. So in summary, it's not about the specific numbers because nobody is going to look at, is it 2.3 million or 2.5 million, at least not in the initial stages. It's about what the numbers communicate about your game plan or the lack of a game plan. And your game plan can be communicated using the TGRR framework. So current traction, growth, risk, and reward. So if you are a startup founder that is looking for investment, do you know what is your strategic cash flow shape? So we have, if that's kind of the question in your mind, then maybe we want to have more a more in-depth discussion with you. So we typically work through accelerators and incubators, and sometimes we also work with founders directly. And the founders that we typically work with to tell a strategic story with their numbers are founders who are preparing to raise about 1 to 2 million pre-series A, and they need to be able to tell a strategic story with their numbers to convince the investors. And these startups are typically already revenue generating, and they have kind of passed the product market fit. And importantly, they would have budget to hire expert support in the ballpark range of 5K and above. If this is you and you want to know more, please text contact me in the Zoom chat and we will follow up with you after the meeting. The next question that you may be wondering is, so what is it that you deliver with these founders? So we will give a taster in the investment consulting package lucky draw. So all of you will have seen our marketing and know that whoever signs up for this event and have already done the Startup Zodiac would be eligible for the investment consulting package. And this package, which is valued at Aussie dollars 5,000, is a typical package that we deliver to the type of founders that we mentioned earlier. So we will provide access to the quick look cash flow tool. So it's a very simple tool for you to project your cash flow. And we will provide personal support, both Yvette and myself, for you to understand the insights from your cash flow. So very much like what we have done in case study 1 and case study 2. And we will also look at the alignment between your Startup Zodiac and what story it really is telling in the cash flow projection, so that your alignment can be tighter. Okay, and finally, just like how we shared in the case study, you would also know your strategic investor ratios, your risk analysis, and your investor X factor based on the reports that we will be providing to you, as well as the insights that we will be sharing with you. Okay, we have come to the end of the session and we're open for Q&A. So is there anything that you would like to know more about from today's session that I either haven't covered or that I was not clear enough? If there is, can you type into the Zoom chat? And we will take questions for the next 10 minutes or so.